Welcome to Online Trading Campus. Welcome to our OTC Futures course, Module 1, Fundamental Awareness. In Lesson 2, we will discover how futures work in the real world. In the next couple of minutes, we are looking at two hypothetical scenarios of how institutional market participants use futures to hedge market risk. One example will be hedging corn prices, another example will be hedging currency risk. Let's look at a real-world example of a corn farmer first. In the spring, the farmer is concerned about the price of his crops when he sells in the fall. If prices drop at harvest, the farmer will have to sell the crop at a lower price. One way the farmer could hedge his exposure would be to sell a corn futures contract. When harvest rolls around and the price of corn drops, he will see a loss in price when he sells his crop in the local market. However, that loss would be offset by a trading gain in the futures market. If prices rallied at harvest, the farmer would have a trading loss in the futures market, but his crop would be sold at a higher price in the local market. In either scenario, the hedged farmer has added protection against adverse price movements. The use of futures enabled him to establish the price level well before he sells the crop in his local market. The first step is producing the product. In our case, the farmer knows how much corn he is planting, which is known as his cash position. In the second step, he will get into an agreement with a processor like Mills who buys his corn. However, the farmer will not receive payment until harvest. While the farmer has to wait for the corn to be ready to harvest, who knows what the corn market is going to do? Prices could go up, they could stay the same, or they could go down. If corn prices stay the same, then nothing happens. The farmer can sell the position at the same price as originally planned. If price goes up, then good for the farmer because he can sell his corn at a higher price. But if prices go down, he will sell his corn at a lower price than originally planned, and there is his risk. Since the farmer doesn't want corn prices to go down, he wants to offset his risk. And this is simply done by hedging. In other words, hedging would be a form of insurance. So to offset the risk of declining corn prices between planting and harvest, the farmer can sell corn futures contracts. So the corn farmer is going to sell short a certain amount of corn contracts. That way, if corn prices go down, the farmer loses money on his cash position, but he will make money from his futures short position, which is a net neutral position. If corn prices go higher, it's the other way around. He now makes money on his cash position but loses on his futures corn contract position. Again, a net neutral position. The purpose of the hedge is to basically stay neutral. You're not going to make money, but you're also not going to lose money. The goal is to protect the assets that you already own. Let's imagine that it's end of December, beginning of January. A farmer who is expecting a crop of 100,000 bushels in November decides to hedge 50% of the crop or 50,000 bushels. By hedging just 50% of his crop, the farmer is limiting, not eliminating, his exposure to price movement. So in other words, the farmer is shorting corn futures. It's a sell to enter position. A single futures contract in corn represents 5,000 bushels, which is by the way equal to 127 metric tons. So the farmer will have to sell 10 contracts to hedge 50,000 bushels. On December 29th, corn futures traded at $4.14 per bushel. From January until harvest in November, the price of corn fell by $0.46 per bushel. The farmer can now buy back 10 contracts at $3.68 per bushel, offsetting the 10 contracts he sold at $4.14 per bushel. So in other words, he just closes his short position with a buy position. The 10 futures contracts generated $23,000 in addition to the $3.68 per bushel the farmer will receive in the cash market. So another question that occurs sometimes is who would have wanted to buy these contracts? Because you always need somebody of the other side of your trade, right? Our example began with the farmer selling 10 corn futures contracts end of December, well before the harvest. Any number of market participants would have been willing to take the other side of his transaction/trade. This includes food processing companies attempting to hedge their input costs, commodity fund managers looking at the price relationship between various grain products, energy companies looking to secure an ample supply of corn for ethanol production, and speculators who wish to express and profit from their opinion on the direction of the market. As a summary, the farmer lost $46,000 in his cash position because corn prices dropped from $4.14 to $3.68 between crop and harvest. But the farmer was able to offset some of his risk by shorting 10 corn futures contracts and made $23,000 profit in the futures market. A single futures contract in corn represents 5,000 bushels, which are, as we said, 127 metric tons. Hence, the farmer will have to sell 10 contracts to hedge 50,000 bushels. Obviously, the farmer could have offset his entire risk by shorting 20 contracts to hedge his entire 100,000 bushels. Let's look at one more example. Given the interconnectedness of today's global economy, it is hard to imagine a medium to large size company that is not exposed to currency risk. Such risk can result from importing parts or components or from exporting finished products to foreign markets. In light of these considerations, companies are well aware of currency fluctuation risk to their business. One way to manage currency risk is to hedge in the futures market. Large commercial enterprises regularly use futures to manage risk, reduce costs, and leverage working capital. Let's imagine a US company agreed to buy heavy equipment from a German manufacturer. According to the terms of agreement, payment will be due upon delivery. To offset the risk of weakening dollar between purchase and delivery, the US company can buy euro futures contract. The cost for the US company will rise if dollar weakens. The added costs are offset by the long position in the euro futures. So let's put some real numbers behind this hypothetical hedge example. Let's imagine that on the 9th of March, a US company agreed to buy heavy equipment from a German manufacturer. According to terms of the agreement, payment of 1 million euros was due upon delivery end of October. Between March and October, the price of the euro in relation to the US dollar will fluctuate. What if the value of the euro were to rise? How would this affect the cost of the machinery? More importantly, how would it affect the overall profitability of the deal? As you can see on the chart, the value of the euro did rise significantly from 1.0836 to 1.1358, which in turn would raise the cost of the US company by $52,000. To protect themselves from this risk, the company could have done two things. First option they have, bought the euros they needed for this purchase on 9th of March. This would have eliminated any currency risk. However, it would have also tied up a large amount of the company's working capital. $1.083 million for 3 months, assuming that the exchange rate at the date was $1.083 per euro. Second, the better options they have, buying futures contracts. Known as going long is a typical strategy used by companies that regularly buy foreign currency, financial assets such as stocks and bonds or physical commodities. In this example, the US company chose to protect itself in September by purchasing 8 Euro FX future contracts. Each contract represents an underlying dollar value of 125,000 euros, so 8 contracts would represent 1 million euros. This amount would completely offset the currency risk associated with the increasing purchase price of the equipment if the value of the euro went up during this period. In this case, on this date, the US company would be required to deposit about $5,000 per contract, which is known as margin, or $40,000 to hedge the currency risk associated with this deal. Because the price of the euro rose, the company had to pay more to purchase 1 million euros on December 1st. However, this increase in cost was offset by the profits realized from being long the futures contracts. By hedging with futures, the US company locked in the price it paid for euros and fixed the ultimate cost of the equipment. Keep in mind, if during this period the dollar strengthened compared to the euro, the futures position would have sustained a loss, but the cost in dollars of the equipment would have declined as well. Let's ask one more question. If the US company was buying euro currency futures, who was selling them? Any number of market participants might have taken the other side of this trade. A company hedging against a possible decline in the value of the euro, a speculator looking to take advantage of an opportunity, or a European company buying products in the United States. As a summary, the company lost $50,000 in their cash position because the euro rises against the US dollar. But the company was able to offset all of their risk by buying 8 euro futures contracts and made $52,200 US profit in the futures market. A single futures contract in euro dollar represents 125,000 euros. Hence, the US company will have to buy 8 contracts to hedge 1 million euros. To sum everything up here, the open and transparent marketplace provided by futures exchanges has become the primary source of price discovery for markets including grains, energy, metal, currencies, equity indices, and interest rates. The dramatic trade volume in these markets allows hedgers to reduce risk and speculators like us to pursue opportunities in an extremely liquid marketplace. So I hope this was another insight into the futures market. And let's move to the next lesson and let's explore the different exchanges that provide us all these markets we can speculate in and also have a closer look into the markets we are able to trade.